Keep all of that in mind. Let's talk about some bond terminology. So bonds payable, this is the most common type of long-term liability. It is one of the accounts we'll see when we do our journal entry. Bond indenture, this is the physical contract that describes the agreement between the bond issuer and holder. So for example, like all of these, some of them are more applicable. We're going to use them. Like I'm going to directly reference stated interest rate and market interest rate. For example, bond indenture, just know it because you might see it in a question. And if you don't know what it is, it might concern you. But here you see this is basically the agreement. This is the piece of paper that says I'll borrow $800,000 for you at a 10% interest rate or something. Face value. I like to call this the clean number. So we're going to see in our questions that, yes, you're borrowing $800,000. So this will be the $800,000. The factored number is going to be the carrying amount. So this is always going to be the clean number, face value, which is the bond's payable amount. It's the total dollar amount of the bond and the principal upon which interest payments are made. So again, if I'm borrowing $800,000 at a 10% interest rate, the face value there is $800,000. Our actual, our interest payments are going to be 10%, $800,000, $80,000. When the stated rate equals the market rate, bonds are issued at face value. This has to do with premiums and discounts, which we are going to talk about. Your stated rate is the rate assigned to the bond by the issuer, which determines the interest payments. And I'll draw this out for you right here. Let's say we're dealing with, we'll keep using our $800,000 amount, just because, why not? $800,000, and we say we're going to pay 10%. However, let's say the market. So this is where we get into the market rate, interest rate, discounts, and premiums. Let's say that, we're Disney. We're Disney. We want to raise $800,000 to build a new ride at our amusement park. However, let's say the rest of the market is paying 12% on their bonds. Okay, so we are paying 10. The rest of the market's paying 12. Well, you're looking for investors. Why would investors accept a lower interest rate on your behalf, right? So this is the average of what everyone else is paying in the market, like Microsoft, Amazon, Netflix, on all their corporate debt. So Disney's kind of being cheapo right here. They're being a little cheap. And what do they get for that? Well, they're actually going to receive less cash because this is at a discount when the stated rate is less than the market rate or the yield. They'll call this the yield, the effective rate. This is the coupon rate. A few words for that there. All right, so this is a discount, and I'm going to make the number up. There are ways to calculate it, but for example, Disney might only receive $775,000 because they're paying less interest. Similarly, let's say that the rest of the market is paying 8% interest. So Disney is actually paying more interest in the market, which is attractive to investors because as an investor, I'd love to get 10% as compared to 8%. Now, why would Disney do this? Well, interest is tax deductible. Maybe they're trying to get more money because also look at it. It's at a premium. Maybe investors are willing to pay $825,000 for this bond. The rest of the market's only at 8%. So investors are willing to pay a little bit of a premium to get a higher interest rate. Again, the calculation of getting those amounts, I'll show you ways to do that. For example, if it says it's issued at 103, well, if it's issued at 100, there's no discount or premium. Issued at 103 is basically just $800,000 times 1.03. And that would get you $824,000. That's the premium. If it's issued at 97, well, we know that's going to be at a discount. So we're going to do $800,000 times 0.97. That gets you $776,000. That's one way to calculate it. Another way is the present value factors. Another, you look at the interest rates, you kind of know, is it a discount or premium? Many different ways. We'll explore them all. Take this slow, right? There's a lot going on here, especially if you've never seen this. Take it slow. Take it in one at a time. It's gonna all work out. So market rate, this is the overall average rate of the interest, right? That's paid out in the market. Stated rate is what Disney specifically is giving on the bond. Discount, we just kind of saw. It's the amount. So Disney's actually going to receive less cash because they decide to do a discount, whereas they're going to receive more cash if they issue a premium. And we will see this. I'm jumping ahead because I think it's relevant to see it here. But the journal entry here is going to always be debit to cash, right? Because why do you issue a bond? You are issuing a bond to receive cash. You're always going to credit. So I'll put it over here. Bond payable. You can call this bond payable, bond liability, a few different terms for it, but it's the same thing. So this is the clean number. Like I said, this is the face value. This is the clean number. That's $800,000. Now, if this was issued at face value, if there was no discount or premium, this would be the journal entry, right? You received an asset of 800 of cash, and you now have a liability of 800 for bonds payable. However, let's say that we did a discount here. Well, you're always going to debit a discount just like you debit a loss, just like you were going to debit an expense. So if it's at a discount, let's say that discount, just kind of making up numbers here, is $15,000. Well, that cash amount is going to be reduced to $785,000. See there, balances out 800 on both sides, and premium, if you didn't guess it by now, would be a credit. So premium, say a 15. Let's say now that we are going to receive cash of $815,000. See, so these are the journal entries, right? So at a premium, we are accounting for this, right? We received more cash up front. Why? Because we're being generous. We're giving a higher interest rate. It's incentives, right? You're incentivizing investors to want to give you more money. And that's, showing you an example is better than any description I could provide for you. I mean, I wrote these, take a look. The bonds sell for more than face amount, right? Bonds sell for less than the face amount, for a lower return, for a higher return. Let's keep moving on. The bonds are a powerful source of long-term funding for companies who need a large amount of capital for construction acquisition. So think Netflix, they take out a lot of debt to film new productions for their service. Disney wants to build new parks. Construction companies want to build new buildings. Debt interest is tax deductible, which is also a great benefit, right? Remember, our two types of financing. We have debt and equity. Equity, you're giving up part of your company. And in debt, you are providing fixed income, right? You're just borrowing money. And bonds represent a contractual promise by the corporation to pay investors at a maturity date and periodic fixed payments based on percent of face amount of bond, right? Think mortgages, think credit cards. I mean, more so mortgages. I'd say that's kind of what we're dealing with here. If you've had car payments or student loans, think of all items such as those long-term. Yeah, because credit cards aren't not long-term. We're thinking long-term debt here. So more words, definitely get familiar with. I just don't want you to see these on the test and kind of get intimidated because you don't know what they are. Debentures are unsecured bonds. Unsecured debt is like your credit card, right? That's why it's a higher interest rate because you don't have any collateral pegged to it. And that's why mortgages are much lower interest rate because, well, if you don't pay your debt, the bank's going to seize your house. So collateralized means there's an asset backing it, and that generally will give you, not generally, it should give you a lower interest rate. Mortgage bonds are bonds secured by real property, and by real, we mean real estate. Collateral trust bonds are secured bonds. So just a couple different words, terminologies here. Convertible bonds. So these are convertible to common stock at the option of the bondholder. So maybe, I negotiate for a convertible bond with Disney and they're paying me fixed payments, right? But then all of a sudden, Disney stock skyrockets. And because I have a convertible bond, I could say, hey, Disney, take your bond back. Give me our agreed upon amount of shares. This will be important for earnings per share and equity and determining how many shares outstanding there are. Just a good term to be familiar with as well. Non-detachable warrants and detachable warrants. We'll see these, but basically just building on convertible bonds. Can you convert those bonds to stock? Don't want to beat those to death here. We will see these more so in our equity section. Lots of great stuff we got going on. And take this section in strides, right? If you need to pause it, if you need to take a break, go, stretch. There's a lot. Starting out with our terminology here, then we'll dive more back into the present value factors. We'll dive more into the premiums and discounts, journal entries, possible SIMs and everything. Breaking it in. This is a lot, but it's all good, right? I'm explaining it. At least I'm doing my best to explain it in a way that I had never had it explained to me, right? Not at a high PhD level, but exactly at the level you need to know for the exam. Here are a couple more terms. I'm not going to really dive into here. Look at these at your own pace. These are just, again, more memorization-based questions. Not as important as understanding bonds as a whole, but if you see these, you could see these as a one-off question on the exam. The one I will mention is zero coupon bonds. So this is a bond that doesn't pay interest. It's got a zero coupon rate, and the coupon rate is a stated rate. So you're basically borrowing money and paying no interest. Now, how does that work? You might be saying, how does that work? What's the deal? Well, think of it kind of like a stock with a guaranteed appreciation. So, $800,000, just keep using that as a magic number. Normally maybe it's at 10%, but if it's a zero coupon, it's got zero interest rate. But at the end of the period, maybe I'll pay you $900,000. So you see there, basically, I mean, you could say that the interest rate then is, $100,000, that you're paying $100,000 of interest, but it's not really interest. It's just, I'm borrowing 800 now, I'll pay you back 900 in 3 years or so. Different reasons you might do that, but zero coupon bonds, you might see a couple questions with those on the exam. But these other ones, take a look at your own pace and memorize. Not too important. I would understand the rest of the bond section first and then go back and memorize these. All right, bond interest rate terminology. So the stated coupon rate, nominal rate. This is what you see just given, right? Disney is offering 10%. And I'm going to call this one the balance sheet one. I'm going to call this the income statement one. And why is that? Well, because this determines your interest payable, right? This is going to be your interest payable, how much you owe the person. And if these sections, right, if what you see here is the same, then there's no difference, right? So this is going to be not bonds. This is going to be interest payable, and this is going to be interest expense. I'm going to move this it's a nice graphic, but I'll move it out of the way for you. So this is the rate written in terms of the bond indenture. So the indenture is the agreement, right? This is Disney saying we're going to give you 10%. And then this is the market rate. This is what generally the market is giving. Bond issuer sets this rate. This is the rate of interest earned by bondholders overall. Now, interest payable, because the whole process of bond amortization, the premium and discount, we're going to see if we've got $800,000 and we use our 10%, Disney's giving 10%, that's $80,000 of interest payable. However, let's say that the market rate, and this will be a little different because we'll have to factor it as well, but I'll just keep it at $800,000 for now. Let's say the market rate's at 12%. That's going to give us a little bit different, right? And that $800,000 times 12%, that's actually our interest expense. So our interest expense is higher. And you see here the difference. This goes on the income statement. This goes in the balance sheet as interest payable. And the difference here is going to be amortizing the premium and the discount. If that doesn't make sense yet, we will see it more, just kind of introducing you to the concept. I would definitely memorize this chart for sure. All right, so I actually went in and updated this a little bit further. Thought of some new things I wanted you to see. I mean, I got to say, no matter how many times, how much time it takes, writing, reviewing these things, there's always more I want to include, but it's just, what's worth your time. So here, we're going to use this balance sheet amount, right? The balance sheet, this is the fair value times the coupon rate, right? The fair value is going to be that clean number times fair value, face value times the coupon rate, the stated rate, what Disney gives you. This is going to be the carrying value times the market rate of the yield. So this is going to be the messy number. This is going to be what you debited for cash in that issuance journal entry. We're also, definitely memorize this. We're going to use the market or the effective rate or the yield to determine the present value factor. That's going to be, okay, we've got a bunch of different factors. Which one do we use? And this determines the interest payments. So like we said, the $800,000 times the 10%, that gives you $80,000 of interest payments. This is interest payable. So this is what interest actually is. Interest expense is what interest should be on the income statement. We'll see this with real examples, real numbers. Let's keep moving on. And those interest rate formulas, so this is more the calculation, kind of just saw it there as well. How do you calculate the amount of interest that is actually paid to the bondholder? Well, like I said, that's the stated rate times the face value of the bond. And how do you calculate the amount of interest that is actually recorded as interest expense by the issuer of the bonds? That's the market rate times the carrying value of the bond. You might be asking, why are there two different things? Why do we care? Why do we not just use one? My answer to you is it's not worth your time to kind of dig into it too much. And it's for accurate financial reporting purposes, right? So the income statement, that's your period of time. Balance sheet is a point in time. And you are essentially reconciling those two amounts. The amortization process is basically taking the difference between what you got and what you should have gotten and straight line depreciating it over the life of the bond. And we'll keep seeing that.